Welcome, and today we're going to talk about the 10th module in the series of this wealth management. It talks about investing for cash flow. Now we're going to understand a few terms here. This is one of the last modules and also happens to be a little technical in nature, but not that complex. You'll be able to understand it once you go through the slides and the explanation that I'm going to give to you. Capital gains make you rich, cash flow keeps you rich. So we're going to basically compare between how to do our investments for cash flow rather than for capital gains, which generally people do mistake and they really go on to invest looking at capital gains rather than looking at the cash flow. So we're going to do a comparison between capital gains and cash flow, and we're going to see which one is a better investing option. We're also going to compare it with one of the popular games that most of us have played in our childhood and our children also play today, and what it teaches us about cash flow. Ask yourself these questions. Have you ever encountered scenarios like you really don't understand the difference between cash flow and capital gains and you're quite confused with these terms? So we're going to clarify that in detail today. You want to earn profits via capital gains, which is typically by selling some of the capital that you have, which could be in terms of real estate or stocks or anything else. But you don't know what would you do once you sell your capital. What are you going to do with the money that you get after you sell your capital? So either you should be ready to buy another capital, or you should be very clear how you're really going to reinvest the money that you get. So it's very lucrative sometimes to sell the capital and realize the profit, but without clarity on what we're really going to do with the money that we get, we can potentially land ourselves in a very negative situation. And even if you want to really do a good investment from the sold capital, you fail to find good investment options that can give you regular cash flow. So we're going to look at how we can overcome these situations and what is the best way to invest your money as far as capital is concerned. So in this module, you're going to understand the 10th wealth creation principle. This is the last in our series, invest for cash flow. And we've already studied the below 9 principles: the amazing power of compounding, pay yourself first, start early, get started, sharpen your financial saw, diversify, the 4 levers, get the right attitude, get rid of credit cards, and now we're going to study about investing for cash flow. So we'll learn how investing for cash flow can help us maintain our wealth. And as I said in the first slide, cash flow is what's going to keep you rich, which is so important after you become rich. While capital gains might make you rich, staying rich is also a very important ingredient of how wealthy people operate. So we're going to really understand how cash flow works. Okay, so first let's understand what are capital gains. So a capital, unlike money, is a fund which is used to purchase something that generates wealth over a given period of time. Let's take an example of a factory where we need to buy certain machines. Now that buying that machine is a capital investment that you're going to do, but it's going to help you generate wealth over a given period of time, because the machine is going to produce certain products which may ultimately generate much more wealth for you. So that's a capital investment, and once you sell it off, you would have made some profit based on the capital investment, not directly from the machine maybe, but from the resulting products. An increase or decrease in the value of capital asset over time is termed as capital gains or capital loss. So whatever was the increase in the value of the capital or decrease in the value of the capital vis-a-vis the price at which the capital was purchased is essentially termed as capital gains or capital loss. Now again, there are various categories in which capital gains or loss are understood. Could be long-term capital gains or short-term capital gains. We call them as LTCG or STCG, and similarly with losses. Now depending on whether you have a long-term gain or a short-term gain, you may be liable to pay a certain amount of taxes on these capital gains. But that's taxation and all is a different subject altogether, and perhaps that's not in the scope of this entire wealth management series, and we're going to cover it sometime in future in a new series that we're going to come up with. Just to understand that capital is slightly different from money. Money is typically what you use for your expenses. You want to buy food and eat, you want to buy some clothes and consume. That's what money is used for. But if you're going to put your money for use, you're going to buy something that's either going to grow in value or something that's going to generate wealth over time, something physical, that's what's called as capital. And some of the examples of capital are real estate, which could be you bought a house, invested in that. So that's a capital investment. It's going to generate some wealth for you. It's going to increase in the value. It's going to create some rental income for you. So all that is a wealth created from that capital asset. It could be gold and it could be stocks in a company. These are all capital investments that you do. And these result in either capital gains or capital losses. Gain or the loss is not realized until the asset is sold. So you may have bought the asset for 100 rupees. The asset may currently be valued as 120 rupees, but we still do not count it as a capital gain unless we sell the asset. So it can continue to show as 120 rupees in the books, but there is no gain which is shown in the books. That's primarily because unless the asset is sold, the gain is not realized. And similarly with loss. So that's how capital gains work. And a lot of us do investments in capital market in terms of investing in houses, investing in gold, investing in stocks, investing in mutual funds. So these are all capital investments, and we may not have looked at these things really that way, but capital assets and capital investments really lead to situations which typically are not what wealthy people really value. So we're going to look at what are the options in front of us if not capital gains. So let's understand what is cash flow. As the name says, cash flow typically means flow of cash into and then out of. That's the flow, right? So some cash flows in, some cash flows out. So you earn salary, you earn business income, that's the inflow. Then you do some expenses, that's the outflow. And so this entire flow of money in and out of your family pool is termed as cash flow. And the cash flow is usually generated by income from family members or from the business that you're doing. And the cash outflow is usually generated by the expenses that you incur, which could be your household expenses or children related expenses or anything that you want you really spend your money on. And if your income happens to be greater than your expenses, then basically you have a positive cash flow, which essentially means at the end of the month you're able to save something. So that's what cash flow is about. So cash flow is about running cash, while capital is an investment which is not running, which once invested stays invested and could potentially give you good returns after 5 years, 10 years, 15 years. We don't know. It depends on various factors, including the investment that you've done. So that's the real difference between a capital gain and a cash flow. Cash flow will allow the money to flow through your hands, while capital investments will not do that, and they would perhaps give you slightly better returns than cash flow, but not having cash in your hands can be a very disadvantageous situation. So here's the dilemma. You need flowing cash to meet your regular expenses, and not only regular expenses, I would say certain unexpected expenses also. You need cash in your hand. Capital gain based investments potentially lead you to higher gains over a long term, but there is no cash flow till the asset is sold. And you cannot really sell the asset at any stage you want if you really want to sell it for the right amount of profit. And so there is going to be some lock-in period, there's going to be some gestation period, there's going to be delayed gratification as far as capital gains is concerned. And there are other investments which we call as cash flow investments, which lead to regular cash flow, which perhaps give you slightly lesser returns, but then has the advantage that the cash is continuously flowing in and flowing out. So the dilemma for an investor is as follows. Should he or she invest for capital gains or for regular cash flow? So let's take a couple of examples. For example, if you are regular in buying equity funds or stocks from the market, then should you really look at the sale of a stock, or should you really opt for investing for regular dividends that you would get from the stocks? And this is a subtle difference. So if you're investing in a stock with the intention that you're going to sell it after 2 years or 3 years or whatever period, or 5 years, and make gains out of this capital purchase and sale, that's one way of looking at it. So you are investing for capital gains. The other way of looking at it is you invest, the capital anyway grows in value, but you also start getting regular dividend income, which is a regular cash flow. You get it monthly, you get it annually, you get it 6 monthly, whatever it is. But you get a regular income, and that income can be used to purchase further capital. That's the difference we're talking about. If you talk about in terms of real estate, if you're if you're an investor who is more focused on real estate investments, then it could be purchase and sale of a real estate. Could be, this is one of the typical examples of a capital investment and sale. Or you might also be looking at more of cash flow investments, which is regular rental income from that particular investment, and that rental income is then used to buy more of real estate and so on and so forth. So which one should you be opting for? That's the dilemma. And while you might have got the answer from the title of this particular module, but there is a very interesting scenario that we can learn from one of the most popular games that you may have heard of. That's called as Monopoly. It's a classic board game, and it's been present for over 100 years now. It's actually a real estate trading game that most of us had played for fun. If you have played Monopoly long enough, you would quickly realize that the game offers a lot of financial wisdom and lessons that can be applied in the real world of finance and investing. So we're going to talk about some of the very, very valuable lessons that not only help you increase your chances of winning this game, but also increase your chances of having better and a useful understanding of various financial and investment principles, one of which is focusing on cash flow. But we're going to look at all five and then perhaps keep our focus on the cash flow lesson that we're going to learn. So these are the 5 lessons that this particular game teaches you. The first one, always keep cash in hand. Now this is very, very important, and when I say the game teaches us this lesson, keep relating this to your own financial life. Always keep cash in hand. To win in Monopoly, you will have to be the last player left with cash. In other words, the last one to have money. And you other players may have either bought so much real estate that they don't have money, or they may have paid rent to you or other partners who are playing the game, that they are now short of cash and they can't really manage their real estate with whatever cash is left. So if you really aimlessly move around this particular game, buying up everything that you see inside, and when the time comes to pay your financial obligations, you are likely to run out of cash. Now, well, no cash, this particular situation means you have to start selling off some of your properties or real estate you acquired at a deep discount as against what you purchased them for. So in this game, you're allowed to mortgage them at a discount to the face value, and which is very close to the real life scenario. And once this happens, unless you get lucky, it's only a matter of time before you really go bankrupt, because you're selling off your property, your mortgage at a discounted, heavily discounted price, right? So it's so important that you just don't go and buy everything that you see. Keep the cash flow going. Cash is very, very important. And that's why you also hear of companies that are cash rich, and those are the companies which are considered to be more stable, and a cash in hand is always going to be a beneficial situation to be in. The second lesson that this game teaches us is have a game plan and be patient. Now, you really got to have a lot of patience if you want to win this Monopoly game, because you just can't win it by buying every piece of real estate you land on. You have to have a general approach on how you want to proceed. If you are impatient and start buying every piece on the board that you land on, you will quickly find yourself out of money and thus unable to do anything except for hoping for the best. Therefore, you have to be patient and really know when to buy, what to buy, and when to take a pass. You don't have to buy everything. Similarly, if you just buy without discipline when investing, you will be placing your outcome on the hope that the market behaves nicely. While on the other hand, successful investors don't invest based on hope. They invest with a disciplined approach. Patience is a very, very integral part of that particular approach. Third key lesson that this game will teach you is focusing on cash flow. Now, it's a very simple game. You start off with some money, and your goal is to be the last player standing with money. The way you win in Monopoly is by collecting rents on property. and that rental income is essentially a cash flow income or a cash flow. Now, not many people know this, but the most valuable properties on the monopoly board with the best cash flow are the 4 railroads. If you own all 4 of them, you put yourself in a very, very good position. With each railroad costing around $200, by owning all 4, you collect $200 in rent, which is almost equivalent to 25% return. Now, this looks very bizarre if you look at the game itself, but this is precisely why Monopoly offers some valuable financial and investing lessons. Over time, your assets increase in value based on the cash flow they produce. So, keep focused on the cash flow, what kind of cash flow an asset is returning, and if an asset returns you good cash flow, continue with the asset. Lesson 4. Most expensive assets are not always the best. Now, most Monopoly players want to own some of the most expensive real estate like Park Place and Boardwalk since they have the biggest payouts, but they're also the most expensive pieces to maintain, and that's where the cash flow is not good. And when many people lose at Monopoly by owning the most expensive pieces because they don't pay attention to the cost, and focusing on the cash flow without taking into account the cost paid to attain these cash flows is like playing the game with blinders on. So those who win Monopoly are investing in the long run, and in investing, the best investments can often be tarnished companies trading at bargain price. Owning Boardwalk and Park Place is not how you win Monopoly. You win by making the most money. In investing, you win by buying low and selling high. When you focus on the most expensive assets, odds are you are overpaying and setting yourself up for losses. And the last lesson that this game teaches you is don't put all your eggs in the same basket. And we already studied about this particular principle, which is diversify. And how does it teach you is you won't win in Monopoly by just owning one property on the board and loading it up with hotels. It's also hard to win if you try and buy everything on the board and spread yourself too thin. Occasionally you might get lucky and have every opponent land on that property, but usually the winner is someone who spreads out his or her properties throughout the board and has multiple chances of capturing rents. And the same principle applies in investing. If you bet everything on 1 or 2 stocks, you're exposing yourself to a potential wipeout if something goes wrong. At the same time, you can dilute your gains by trying to own 100 different stocks. So you got to diversify, but diversify intelligently. So most of the studies have shown that best or the most optimum diversification happens with 10 to 15 securities in hand. Don't just bet on 1 or 2 assets and try to keep within those 15-20 securities that you want to maintain. So with all these lessons that we learned from Monopoly game, the first few points primarily focused on the cash flow part. Keep your cash in hand because that's what will really help you buy at the right time. Have a game plan, be patient, keep collecting rents, focus on the cash flow, and it's not necessary to buy most expensive assets. You've got to look at the cash flow and the cost that's going to really go in maintaining that particular asset. And of course diversification, which we already studied earlier. So that is the key importance of cash flow. Companies which do not have a good cash flow, and even though they may have huge capital investments in capital assets, not really the ones that are preferred by the market. Similarly, when you go out and invest, while capital gains is important, but investing for cash flow is really what's going to really make you stay wealthy, because with cash in hand you are able to take the right buy decisions at the right time. And somebody who's invested only for capital gains is going to land up in a situation where he or she would have no cash and would have to either sell some of his properties to really manage his cash expenses, or he may not be able to buy at the right opportunity because it's already locked in his money in a capital investment. So to summarize, you need cash in hand to handle expected or unexpected obligations in life, and therefore cash flow becomes vital, much more vital than capital gains. If you're not cash rich, you might have to sell off some capital assets at throwaway prices, which is of course not a very desirable situation. Always look for good cash flow along with decent capital gains rather than huge capital gains and no cash flow. So always your preference is looking for cash flow, while capital gains become secondary. This principle, when integrated with other wealth management principles, will serve you well in life. So I hope you understood how critical looking at cash flow is vis-a-vis looking at only the capital gains for a particular investment that you're doing. So if you want any other clarifications, you're free to write to us at help@manoj-arora.com, or you can also visit our website at www.manoj-arora.com. Thank you.